battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show, episode 205. I am Nick Stenger. We are the Stenger Family Office. For the past 44 years, the Stenger family has made it our mission to deliver both clarity and confidence to help secure your financial future. Thanks for being back on the show this week. We missed last week, but we're back at it. We're going to try and not miss a week for the rest of the year, and hopefully we'll get a little Santa Claus rally here, and maybe, just maybe, we'll bring out the Santa Claus suit from last year like we did. And what a record year. What a great year. 6,700 points. We blew way past that. We said 6,700 at the start of the year, and we went up to about 6,915 at the high end and corrected just a percentage point off of that. But here we are at basically a record all-time high in the S&P. Everybody wants to know, is this another bubble? Are we in a bubble? Is it going to burst? What's going to happen next? And what I will tell you is there will be a correction at some point. I've been telling you this on the show every other week or so, just saying, just be prepared for the fact that after you run up 16, 17, 18% in the stock market, after a 20% year like we had last year, don't be surprised if you eventually hand some back. Even this year in 2025, everybody has short-term memories with this, but we did have a 19% pullback in April off of the Liberation Day and the tariff news. So don't be surprised. Even in a year where we end up the year positive 15, 16, 17%, which is, by the way, a phenomenal year in the stock market, you could have an intra-year drawdown that could be in the double digits. Do not let that shake you off your plan. And I would also argue you're going to see another one of those, probably not this year. I doubt that we'll have a 10% drawdown in 2025 again, but you could see 3 or 4 or 5%. It's going to feel really bad. It's not bad. It's 3, 4, 5%. Just put it in context. And then next year, I do expect a 10% pullback. We don't have it typically every single year, but every 18 months or so, you could see a 10% pullback. And that mathematically would put you sometime in the summer next year. If we rally past 7,000 points really quickly, some places out there in Wall Street are calling for 7,500 on the S&P in pretty short order. I do think we're going to hit 7,500, but if we hit it too soon and the earnings just aren't quite there, we start trading the S&P at 26, 27 times earnings, then we're going to have a pullback, absolutely. Markets are used to this. If you've been an investor for a while, you're used to this too. So don't let it spook you. Don't get spooked off your plan. In fact, I send out internal research notes to our team on a regular basis, and I found one from February this year before all the tariff panic set in, and when the market was at a brand new all-time high at that time, which was in the 5,900 point zone, almost 6,000 points in February of 2025. And I sent out a note to our group, and I said, this is what the math of the market supports. I thought that the market at the time still supported 6,700 points like we put out our target, but I also said to our group at that time in February, don't be surprised if we see a pullback. Now, I didn't know that April was coming. I didn't know that Liberation Day was going to happen. I didn't know the S&P would be down 20% like that, but I did know we were due for a correction just based off of regular market cycles, just general changes and shifts in market sentiment. And that's exactly what happened. But I also said, use it as a buying opportunity. And if you've been following the show now for a while, if you've been watching all of 2025, you've heard me say that. You heard me say back in April, S&P at 5,000, buy, like it's going out of style, like there's no tomorrow, because you know that at 5,000 points, the S&P was undervalued. So all that to say, we titled this week's show, Bubble or No Bubble. And what I'm going to just summarize this with is to say there's no bubble for the general S&P yet, but there is a bubble in some parts of the S&P. There is a bubble certainly in some AI names, and I'm going to show this to you in a second. But let's just look at the general S&P 500. We've got producer Katie the Greek with us today. Katie, if you've got that up on the screen for us, S&P 500 as of November 4th this year, there's 475 of the 500 companies that are profitable, about 95% of the companies. That's really good numbers. In fact, if you go to the small cap or the mid cap indices, it's not even close to that. In fact, many of these numbers are flipped where only about 30% are profitable or 40% are profitable. So the S&P is very, very profitable for the most part. 228 of these companies, about 46%, have grown their revenue and profits the past 3 years. That number is just slightly higher in the high 60s if you go over the past 5, because remember that had COVID built in. But now we're past COVID by a wide margin. So if you go back 3 years, what you're doing is you're taking out the COVID bump and you're only looking at companies that could actually grow past these big gains that they got during COVID. So these are very good companies now. If you narrow down the S&P to those 228, not every one of those companies is perfect. Not every one is undervalued. That's for sure. But those 228 are in a league of their own. The fact that they've been able to grow like this since 2022. And 83% of the S&P 500, of all 500 companies, are reporting positive earnings surprises for the third quarter of 2025. So just remember, the data behind the market today is actually suggesting that markets are fairly valued. I wouldn't say they're completely undervalued. They're not like they were when the S&P was 5,000 points in April. But I disagree with the idea that the S&P is radically overvalued. I would say earnings estimates are actually coming in right where they should be. FactSet also came out, who produces that number on the 83%. They also came out today, published a report, and said S&P companies are publishing double-digit earnings growth at a record level. Now, let me give you the breakdown of some of the companies in the S&P, some of which are very, very high priced. I'm not talking about their stock price. I'm talking about their PE ratio, their price to earnings ratio. That's what we track very closely. We like to look at forward PE. We don't want to look backwards. We want to look forward. And starting with Palantir, which is one of the priciest companies, not the priciest, but one of the priciest in the index, trading at 670 times current earnings, but its earnings are going up, so its forward P is going to be 384. You think, wow, what a steal. The 5-year average, though, on Palantir is 82. This is a pricey company. Absolutely no question about it. Now, I'm not here to tell you Palantir is a bubble. I'm not here to tell you that it's it's a Fugazi-Wazi company. But what I am telling you is just be prepared. If you buy a stock like this and the market goes down 10%, a stock like this could go down 30% like clockwork. It would not surprise me at all. Here's Tesla. Tesla's trading at a 305 current PE with a 292 forward. The average over the past 5 years is 77. Tesla is much pricier today than it was 5 years ago. Here's another one. Palo Alto Networks trading at 135 current PE, but its forward is actually going to drop to 57, which you'll see in a second. I don't think is that crazy given the growth rates. And its average over the past 5 years is 54, right in line with its 5-year average. ServiceNow at 110, forward P is 48, a little bit pricier, actually a little bit less pricey than its 5-year average on a go-forward basis. There's Broadcom. I won't read every single number off to you. Here's Robinhood, Arista Networks. Here's Oracle trading at 60 times earnings, which is much higher than its 5-year average at 19. NVIDIA actually trading right in line. I covered this at Investor Day if you came out to our event we did a few weeks ago. NVIDIA is actually trading at 41 on a forward basis. 39 is its 5-year average, not radically overvalued. And you've got Costco right in line with its 5-year average, even after going up a ton the past 4 or 5 years. So in a bubble, in a vacuum, you would see these numbers and you'd say, wow, the S&P in general is trading for 24, 25 times price to earnings. And you have all these companies trading much, much higher than that, 50, 60, 70, 100, 600 times PE. Are these companies in a bubble? The answer is not necessarily depending on what the Fed does, because if the Fed continues to play ball, and I mean the Fed stays a little bit looser on interest rates than they have been, or at least have a general trend downwards, there's a saying in the investment world, don't fight the Fed. So when the Fed is raising rates, you don't want to fight the Fed and be all bulled up, because you're probably going to get toasted when rates really do start going up, just like we saw in 2022. But at the same time, on the other side of the equation, when we say don't fight the Fed, if the Fed is pumping liquidity in the system like they are, if they are cutting interest rates and their general trajectory is lower rates for longer, don't fight the Fed on the other side, because you could see this bull market continue. And what I want to point out is also the fact that you cannot time these bull markets and you cannot time a bubble. Everybody who has two thumbs on Twitter right now is saying the market's in a bubble. If I talk to my clients, you get about 720 clients or so at Stenger Family Office, and I talk to a lot of them. If I talk to our clients and hear what they have to say at events or one-on-one meetings and all the rest of it, a lot of them say the same thing. Nick, this has got to be a bubble. This thing's got to end. The market's frothy right now. Aren't you worried the bubble's going to burst? One thing I would just say is the market is never in a bubble when everybody thinks it's in a bubble. If everybody, including your neighbors, your family, your friends, your kids, say the market's in a bubble, that's not a bubble. It's a bubble when nobody expects it. It's a bubble when people are quitting their day jobs to become day traders. And so far, we just don't see evidence of that. So if you go back to 1992, leading up to the tech crisis and the bubble of 1999 and 2000, that's exactly what you saw. You saw a slow melt up. In fact, you could trade the S&P at 23, 24, 25 times PE longer than you think. And by the way, the market can keep going up more than you think longer than you can stay liquid. So this is a big problem for people who want to short the market. This is a big problem for guys like Michael Burry, the famous hedge fund manager from The Big Short, the movie that talks about 08 and 09. And so these guys, remember, have called like 15 of the past 3 major pullbacks in the market. They're always saying the market's coming crashing down. They're always going to tell you the world's coming to an end. They're always going to tell you the sky is falling, but they're not going to be right more than once every maybe 10 or 12 years. That's how often these big crises happen. We have not had an 08, 09 scenario since 08 and 09. And there have been people every single year since 08 and 09 telling you why the world's coming to an end, Chicken Little, run for the hills, build a bunker in your backyard and fill it with canned food and gold bars. And they've been wrong. And if you listen to them, it costs you a lot of money. So I think we're in the very, very early innings, even for a lot of pieces of AI, for some pockets of the market that are overvalued. I still think we're in early innings of where those valuations could go. And all that to say, it could be that 2025 and 2026 are like 1992, 1993. And you have to remember, 92 was a great year, 93, 94, 95, 96, 97, 98. All those years leading up to the actual burst were very good times to be an investor. And in fact, if you started investing, for example, in 1992, and you held all the way through 2005, 6, 7, 8, even after 08 and 09, even after 1999, you still got 7% annualized returns. The only people that got absolutely toasted were the people who bought in at the record all-time high, the peak in 1999 or 2000. So everybody is going to ask the question then after this show and say, well, is this 1999? Is it 2000? Or is it really 1992? And so what I want to show you is a couple of case studies here, one being Netflix. And so Netflix just came out with earnings, and they did pretty well. Phenomenal company. Everybody thought they were over with a couple years ago when they had their big pullback. In fact, at the end of 2021, Netflix went down 74%, if you can believe it. Now, Netflix is back, basically not quite to a record all-time high, but getting close. And their market cap is $474 billion, trading at a 47 price-to-earnings ratio. Some people are going to look at that PE at 47 and say that's kind of rich. That's pretty pricey. What do you think is going to happen to Netflix? Well, I just look at the numbers. I look at the data behind the scenes, and I say their projected revenue now in 2025 is $46 billion. They should do about a $10.2 billion profit off of that net income, off of that $46 billion revenue. And they've got 302 million subscribers, if you can believe it, at an average price point of $12.70 a month, which I think over time is going to go to $15 a month. They've already raised prices in the U.S. to that. They'll continue to do that across the globe. They also brought in 19 million new subs just in the fourth quarter of last year alone. And so when we project this out, now this is anyone's guess, this is very crystal ballish, but I'm going to give you a couple of data points. In 6 years, if Netflix continues growing at about 14, 15, 16 million subs a quarter, like they seem like they can, by 6 years from now, they should have 700 million subscribers. That's still only 32% of global households. Their revenue then would increase to $126 billion. And I think at a 25 price to earnings ratio seems fair, coming way off of that 47 high like we are today. Netflix's market cap would be $750 billion. So if you do the math on Netflix, remember, we're going to trade after 5 years on the 6-year expectation because we're always forward looking. So we calculate 6 years of growth for a 5-year return. Annualized return on Netflix from today through the end of 2030 would be 9.6% per year. And I think these are relatively, not the most conservative assumptions, but relatively conservative assumptions. Now let's look at another one. Costco. Costco today has a $404 billion market cap, about a 50 PE like we showed you before, 40 on a go-forward basis, projecting at $344 billion of profit, very low profitability, but $10.5 billion, most of which, as we know, comes from subscriptions, being a member. They have 914 global locations. They do $376 million in revenue per store. Absolutely insane, massive numbers there. And again, we look at a 10-year return with 11-year numbers. In 11 years, we say, based off of Costco's growth rate, they could have 1,700 locations, which is still small. Walmart has 10,500 locations across the globe. Costco, we're projecting just 1,700. Their revenue would be $850 billion. And at a 25 PE, its market cap would then be $1 trillion. If you annualize that growth out from 2025 to 2035, 10 years, you're looking at 10% per year, including a 0.5% annual dividend. So I look at these numbers, Netflix, Costco, I could give you 50 more examples, but I just wanted to make this very simple to understand. If you look at these companies on an individual level, the growth is supported, the numbers are supported by the data, by the actual results. Now, who knows? Maybe Costco steps on a giant rake. They make a big mistake. Something bad happens, and this doesn't occur exactly like we think. Well, that's okay. You've got a portfolio of 60 companies if you're with Stenger Family Office. So all that to say is you do this across the S&P 500, and you look at 2025 earnings. This is the next chart. 2025 profits this year are expected to come in at $270. Remember, the S&P is trading just shy of 6,900 points. Next year, we're expecting $306 of earnings, and I think we're going to trade the S&P just shy of 7,500 points next year. Then in 2027, I think we're going to do $340 in profit. In 2028, remember, we're always forward-looking, and that puts us at an S&P level of 8,250 by the end of 2027. So this is very normalized earnings growth. These are not high growth rates. These are not super crazy numbers that are unachievable. These are average numbers we've seen the past 5, 6, 7 years now with all the technology that's rolled out and how the companies are saving money. And what does that do? Well, if you buy the S&P today, basically at the record all-time high at 6,850 or whatever it closed at this afternoon, and you hold for 2 years, with dividends, I think you're looking at 10.6% annualized per year the next 2 years. Now, what's the long-range return on the S&P, like Dr. Siegel told us in Stocks for the Long Run the past 200 years? The annualized return on markets is 10% per year. This is not radically different than what we've seen for 200 years of market history. And I would argue that 10.6% is really just a function of basic math. And so what we do to get a stock's expected return is we're going to do a couple of things. One, we're going to look at what we think inflation is. Companies are at least going to grow by the rate of inflation, at least the good ones. So let's say inflation's 3%. You got 3% right off the bat. Then you're going to have maybe 1 or 2% of buybacks. You may have 1 or 2% of dividends. So add another 3 or 4% to expected return. Now you're at 7%. And even the worst companies in the market are going to do a little bit of innovating. So they may add another 1%. That's why you'll see a value stock compound at about 8% per year. Then alternatively, the best companies, the companies like NVIDIA, Microsoft, all the high-flying tech companies that are innovating at a record pace, I think are going to add a 3 to 4, maybe even a 5% innovation premium to that 7% baseline return. That's why you're starting to see the bulk of the S&P, the best companies, the top 50, top 60 companies do about 12 to 13% per year. They're just innovating better than anyone else. And that doesn't include acquisitions. It doesn't include more aggressive buyback programs. It doesn't include higher dividend rates like banks that pay a 3% dividend. So all that to say, the data supports where I think returns have been and where they're headed. Now, it doesn't mean that we're not going to have a 10-15% pullback at some point. And I'm sure somebody on YouTube in the comments is going to send in a nasty comment, and they're going to say, Nick, I can't believe you said this. You said the market wasn't in a bubble, and now we're down 15%. Told you so. We were in a bubble. Well, hindsight's going to be 20/20, of course, but I have been through this enough times to tell you that every single time a correction occurs, the bears come out of the woodwork. They always say the same thing. This is it. This one's different. Now's the time to panic. Here's why you gotta get out of your stocks. We've been doing this a long enough time at Stenger Family Office to know the narrative that will be told. So if you're watching our show, if you're our client, we are here to tell you the opposite of that no, it's just going to be a normal correction because, again, the data supports what's going on with stock prices. Doesn't mean there's not going to be a pullback. Doesn't mean there's not going to be a correction. But we will make it through the other side as long as we look very closely on an individual level at the different stories of the companies in the S&P. And that's why it's so important you know what you own. It matters that you see the stocks in your portfolio, that you understand what you've got so that when you do go through a pullback or a correction, you don't get off your plan. Now, let's compare and contrast this return in closing to other potential asset classes you could buy. So remember, S&P return, I think, over the next 2 years is going to be about 10.5% a year, same as the 200-year average. Here's what's happened with different asset classes. So 30-day T-bills paying a little bit more today than they were 5 years ago, but the 20-year return on T-bills is still only 2.7% per year. That's going to be slightly higher today at 3.4 to 4%. That's the Stenger Family Office internal projection. Bonds, we're talking about mostly corporate bonds, some government agencies, things like that. The 20-year return on bonds is 3.2%. Now, by the way, these are all nominal returns, not including inflation. I think bond returns are going to be a little bit higher going forward, 4 to 5% almost. Here's real estate. You think real estate is this great hedge? Well, real estate has really only done 4.9% a year the past 20 years, and I think actually real estate returns are going to fall. These yields make it very tough to find properties that you can make money on today. And we have a lot of professional real estate investors as clients who work with us on the stock side of their portfolio. And they'll tell you the same thing. It's hard to find a property today at these cap rates that's going to work. So I think real estate's actually going to be worse than bonds going forward. Here's U.S. equities. Remember, 20-year average has been 11%, slightly over the 200-year average. But I think going forward, you can expect 9 to 11%. We went through the math just a second ago. So when you factor in inflation, when you factor in taxes to this equation, let's say you're going to go put all your money under the mattress, and we've got a 3% CPI number. We've got 3% inflation. You are going to lose money net of taxes and inflation if you keep your money under the couch cushions. It's just not going to work. You're going to have a negative return. Bonds, you're just barely going to break even if you're lucky. Real estate, you're just going to squeak out a very small gain. The only place, and this is Dr. Siegel, Stocks for the Long Run, who also said this, the only place that you're going to beat inflation consistently over time is where? U.S. high-quality companies. Now, I want to show you the other side of the market. This is my last slide for you today. And these are the companies that don't get a lot of attention. They don't get high-flying headlines in the press, and they're not that exciting. We all understand what they do. They're sort of boring companies, and these are lower-priced company stocks in the S&P 500. I would just point you over, and I'm not telling you to buy any of these. I'm just showing you some of these are in the Stenger Family Office portfolios. But Charles Schwab today will do about $5 in earnings. They're going to trade about 19 times those earnings. That's pretty reasonable. That's actually lower than their 5-year average and lower than their 10-year, I believe. JP Morgan is going to trade at 15 times earnings. You've got ExxonMobil there, 16. T-Mobile, John Deere, Home Depot. Even Amazon. I know this doesn't sound like a value company, but I actually think if you look at Amazon today at a 30p, it's actually a pretty reasonable price to pay. Now, I'm not giving you stock advice. Don't do anything in your personal portfolio based off of the show. This is just informational purposes only. But what I am telling you is when you look at the data, not every company in the S&P is trading at 600 times earnings. And in fact, I think there's a lot of opportunity out there if you are more careful, if you use a scalpel and you you actually go through company by company like we do, and you're careful of what you're owning, and you're getting into the best names, there's still so much opportunity. And that's been true in every market environment. That was true in the 90s, even at the height of the tech bubble. It's been true in every market environment: Brexit, Grexit, COVID, 08 and 09, 1987 with Black Monday when the market went down 22% in a day. Every single market has had winners and losers, and there's always a way to make money in markets if you're careful about what you're buying. Watch price, watch what you're paying, know the companies you own, and know the stories of why you're investing in certain companies at certain times. So that's what we help you with at Stenger Family Office. I am here to tell you that the general market today is not in a bubble. That does not mean we're not going to have a correction. Be prepared for a pullback. Be ready. Be armed and ready for a pullback. It's going to happen at some point. But that's when you get more money to work. You certainly don't want to panic, and you want to stay on your plan. Thank you for being with us for episode 205. We're going to see you next week for episode 206.